Good afternoon, my name is Ana Preciado.
I'm Jennifer Malatesta.
I'm Jose Flores.
And I'm Ricardo Partida.
We are Group 7, and today we are presenting Springsteen's analysis of their current job order cost system and a possible implementation for a standard cost system. Benefits of changing to a standard cost system will be further discussed by Jennifer. Jose will be speaking about possible variances if Springsteen's were to use the standard cost system. And Ricardo will talk about Springsteen's July performance, and I will finish off with some management recommendations.
Recently, Springsteen was faced with intense competition from overseas guitars manufacturers. We analyzed whether the company should keep its current job order cost accounting system or implement the new standard costing system. The current cost system had several weaknesses that made the data unreliable and misleading. Generally, the job order costing system is used only when products manufactured are sufficiently different from each other. However, Springsteen manufactures only two products, classical and flamenco acoustic guitars, that are the same material but different types. As a result, we recommend that the company should replace their old system with the standard costing system, as it will provide better product information for decision making.
To quickly define variances, a variance is the difference between actual costs incurred and the standard cost in which it is measured. It can also be used to measure actual and expected sales. Therefore, variance analysis can be used to review performance on both revenue and expenses. There are two types of variances that can be used in a standard costing, which are rate variance and volume variance. A rate variance, which is also known as a price variance, is the difference between the actual price paid for something and the expected price multiplied by the actual quantity purchased. The rate variance designation is most commonly applied to the labor rate variance, which involves the actual cost of direct labor in comparison to the standard cost of direct labor. On the other hand, volume variance is the difference between the actual quantity sold or consumed and the budgeted amount multiplied by the standard price per unit. If the variance relates to the sale of goods, it is called a sales volume variance. If the variance relates to the use of direct labor, it is called the labor efficiency variance. Finally, if the variance relates to the application of overhead, it is called the overhead efficiency variance. Variance is based on either changes to the cost from the expected amount or changes in the quantity from the expected amount. The most common variances that a cost accountant usually implements to report on a subdivision within the rate are the volume variance, are the categories for direct materials, direct labor, and overhead. It is not always considered necessary to implement variances unless the information is material enough for management to improve the operations or lower the cost of a business. In relation to the job costing that Springsteen is using, if it were to use a standard costing, it will differ in how direct costs are traced to the cost object and how indirect costs are allocated to the cost object. The standard costing of variable manufacturing overhead costs allowed for output will be lower than the normal for job costing. This will lead to an unfavorable manufacturing overhead.
After evaluating Springsteen's July performance, we have indicated the appropriate action for management to take. Our forecast predicts that as of June 30th, 2016, Springsteen Co. does not have enough cash on hand to pay off the full amount of the $35,000 note payable. The company needs $12,299 to pay off the full balance due on the note payable. However, Springsteen will have enough cash on hand in subsequent months because sales of guitars are much higher during the winter holiday season. This excess cash earned during the holiday season will allow Springsteen to pay off the $10,000 of new equipment and $5,000 of dividends to its shareholders.
With this said, we believe Springsteen would benefit from standard cost system for better product pricing, more accurate budgeting, improved inventory costing, and an appropriate capacity choice, making them able to continue having positive performance not just during their high season, but throughout the year. Thank you.